Gleason?
Yes.
We have a public finance class together. We were told to interview someone about why income taxes matter.
Really? Come take a seat. It's never too late to learn that the government is a greedy piglet that suckles on a taxpayer's teat until it has sore, chapped nipples. Taxes. Where do I begin? Perfect. Let's start with income tax. This is your income. Now, it's your income. You should be able to do whatever you like with it, right?
Yeah.
Okay. But here I come, the government. And I get to take 20%.
That's not fair.
You haven't seen anything yet. Do either of you have kids?
No.
Perfect.
Oh, but I do.
What about property?
Yeah, I have some property. Yeah, we have
Okay.
some property.
Did either of you sell any stocks for a profit this year?
Yeah, I did. Yeah. Okay.
Okay, you're learning.
We only have 60% of our sandwich left. How do you expect us to feed our families with that?
Tax credits. There you go.
Well, that helps, I guess. It's a little bit.
Yeah. Now, do either of you work for a corporation?
Yeah.
Yeah. Okay. Payroll tax.
You got a little bit of mustard in your.
Don't sass me.
We pay all these taxes. What are they used for?
I work for the government. They pay me. They fund roads. They fund education. Don't forget about corporate income tax either. There you go.
That's not a lot of money left over.
Yeah, what are you supposed to do with that?
Well, don't spend it. Got to remember about sales tax.
Thanks for nothing.
Yeah.
I think this lesson's been well received. So let's recap. I taught those two about income tax, payroll tax, child tax credits, federal income tax, capital gains tax. Some people would say that taxes are necessary for a functioning government. I call it thievery. Wait till I teach these two about the Green New Deal. Hey guys, Ian with Group 2, covering individual income tax. All of our topics are individual and corporate income tax and elasticity and tax shifting. I want to dive right in because obviously I don't have a lot of time here with this video. Just have a few minutes to go over some things with you guys. What exactly is taxed to the individual taxpayer? Well, they're taxed on their income, any capital gains they might have, retirement. There's a number of other things as well. I just wanted to touch on some of the more important ones. They come in different forms as well, as you can see there. Deductions versus credits, it's important to remember there is a major difference here. Primarily when they're applied. Deductions are kind of earlier in the process. Credits are later in the process when you're calculating your tax liability. Two different kinds of deductions, itemized and standardized. We've gone over this before. Standardized for individual is $12,400. Standardized for married filing jointly is $24,000. People talk about a marriage tax. This is because if the individual were simply doubled, it would be $24,800, but is not. It's $24,000, so there's an $800 difference there that married filing jointly isn't able to capture in a standardized deduction. Pretty much you'd only itemize if your itemizations equal more than 24,000. For most of us at this, I guess, period in our lives, we're not really breaking that threshold, so we'll most likely use a standardized. And they did, those numbers I gave earlier were increased from previous years, so that's as of 2018. Credits, I mentioned earlier, applied later in the process of calculating tax liability. They're subtracted from the tax liability, not the income, based on meeting certain criteria. Not everybody qualifies for a certain tax credit or the same tax credit. They are more impactful to an individual. They have more of an impact, a positive impact on an individual's tax return. Some of the ones you'd be familiar with are ones related to education, maybe children, like American Opportunity Tax Credit. There's another educational one I can't remember off the top of my head. There's a child tax credit, earned income. There's a whole slew of them. AGI is calculated by subtracting deductions from our tax base. There's a good meme for you. Kind of like this one. Exemptions, a little different, happens after AGI is calculated. This is older data, 2013 is showing here. That was the latest that the book showed, and it's adjusted annually for inflation. So one exemption being worth $3,900 in 2013 is obviously going to be different now. I wasn't able to get a figure on that, so it should be different. I just don't know what it would be. One exemption per family member phased out beyond $300,000 of AGI, and the way they phase it out is there's a 2% reduction for each $2,500 that you're beyond that $300,000 threshold. The idea was exemptions were introduced to compensate for the cost of raising children, and it is kind of seen as a tax relief for particularly lower income families, because as you can see there, a greater exemption amount results in a greater AGI for a family. Here are the differences in tax brackets between 2017 and 18. I don't want to get into everything with you, but just briefly, the two biggest ones you'll probably notice are the top and bottom tax brackets. The bottom one now not having a tax. The top one, instead of being 39.5%, being reduced to 37%. This is an important one to know, the difference between average and effective tax rates. You're still taking that tax liability, but you're dividing it by two different denominators. For average, you're dividing by taxable income. For effective, we're dividing by total income. These figures that I have here in the slide are from the example that we used in class. We started with $80,000 total income, had $30,000 in deductions. We're left with $7,000 in tax liability, and then use that to calculate average and effective tax rates. Marginal tax rate's pretty easy to grasp. It's whatever tax bracket you would be in with your next dollar of income. Most of the time that's going to be whatever one you're in, except if you are experiencing bracket creep and pushing up against the next bracket, then you might have a different marginal tax rate than what you're currently in. Different definitions of income, obviously. Haig-Simon's mostly looking at the monetary value of an individual's purchasing power. Does something give them purchasing power? On the other hand, the income tax definition is basically income is from whatever source derived, and then listed there are some of the sources of income that it would be talking about. Capital gains and losses. The important thing here with capital gains and losses is that you're going to have a gain when you have an increase in the value of an asset. You're going to have a loss on the other end of the spectrum if you have a decrease in the value of an asset. But that doesn't necessarily mean that you will have realized that gain or loss. It might still be an unrealized gain or loss if you haven't sold that asset. Once you've sold it, you then have a realized gain or loss. You'll be taxed on a gain. You would have tax benefit on a loss. And then there are differences between short and long term. Short is less than a year. Long term is a year or greater. They are taxed differently. That's why that's important to remember. The figures that I have there are as of 2018, according to the Tax Foundation. Short term is a tax court according to ordinary income tax brackets. Long term is taxed differently. You can see 0, 15, or 20%. It is still kind of based on what tax bracket you're in, but not precisely whatever the tax rate is in that bracket. And then finally here, calculating tax liability. This is really important to know how to do. Start with your tax base, subtract deductions. Now you can see later on in the process it says compare larger, standard, or itemized. I don't know why this is listed later. I would assume this would be up here in this area. If you're subtracting your deduction, you've probably already figured out which one you want to do, itemized or standardized. But anyway, you're going to subtract out your deduction. You're going to be left with AGI. Then you're going to subtract exemptions. How many children are you claiming, property, other things like that. And then you're going to be left with taxable income. That's when the ordinary income tax bracket rates will be applied to your taxable income. So then you're left with this taxable liability that you owe to the government. And then that's when we're going to factor in tax credits, the ones we mentioned earlier, educational ones, children ones, adoption ones, earned income. And then we're going to be left with this net tax liability. So here would be your gross tax liability, and then here would be your net tax liability in this area. So hopefully that's beneficial to you and helps kind of just refresh your minds on some of the things we've already learned. Again, this is all involving personal income tax, and there are others that my group mates are going to touch on. Thanks.
All right, my name is Landon Johnson, and I'm going to talk a little bit about corporate income tax, which is really pretty simple to understand. It's a pretty basic topic, unless, of course, you're the one that's filing the taxes for the corporations. But as a basic understanding, it's a flat tax that the United States imposes on all profits of corporations, and it's a 21% tax rate, which this is significantly lower than 35%, which was the rate up until 2017. And in 2017, the corporate income taxes raised almost $300 billion, which accounted for 9% of federal revenue and 1.5% of the United States GDP. Corporations do have a lot of deductions available. Basically, all current expenses required for the operation of the business are deductible. This includes investments and real estate purchased for the intent of generating income, also employee salaries, health benefits, tuition reimbursement, bonuses. There are a ton of deductions, and companies are always going to be focused on just minimizing their taxable income. And so this can be done a lot of times primarily through depreciation. Companies have the ability to depreciate their assets through several years, which decreases the amount of taxable income which they have. They also can reduce it by due to insurance premiums, travel expenses, bad debts, interest payments, sales tax, fuel and excise taxes, and then also tax preparation fees and legal services can be used to decrease their overall taxable income. And of course, with corporate tax, we do have double taxation. C corporations are taxed on their own income, and then shareholders have to pay individual income tax on any dividends that they receive. And so that's double taxation because the corporations are being taxed as well as the shareholders. This can primarily be resolved with S corporations, which are pass-through entities, just like an LLC. They don't pay any income taxes because that all passes through to the individual tax returns filed by the shareholders and the owners. So it's really a pretty simple topic. Individual income tax has a lot more nitty-gritty details, and the corporate income tax is really just kind of a flat rate that is allowable for a lot of deductions and minimizing of the taxable income.
Hey guys, Ian again. This time talking to you about elasticity. I'm assuming most of you know just as much as I do about elasticity, if not more, but hopefully this can, like with the individual income tax, just refresh you on the topic a little bit more. So this one will be a little bit shorter than the last one. There's not as much to cover. What is elasticity? It's basically just a measure of sensitivity. Specifically, it's a variable's reaction to a change in another variable. To what? Usually we're measuring price elasticity of demand. So we're measuring the change in quantity demanded or supplied with respect to a change in price. That's not the only case scenario, though. We also look at income elasticity of demand, which is a change in quantity demanded with respect to a change in income. Cross price elasticity of demand, which is a change in good A with respect to a change in the price of good B. Elasticity of labor supply, which is a change in quantity of labor supplied with respect to a change in wages. There's a whole slew of other ways you can look at elasticity. Typically, you're looking at price elasticity of demand, but we'll get into how it relates to tax a little bit later. So this is how you calculate it. Basically, a change in quantity demanded, like we just said before, versus a change in price. If you want to break it down even further, on the right side of the screen there, the percent change in quantity is broken down as the change in quantity divided by quantity. Then likewise with the percent change in price, a change in price divided by price. Okay, what does it mean when you get their results? Well, we're taught that an elasticity measure of greater than 1, well, greater than or equal to 1, tells you that the demand is elastic, so people will balk at a change in price. Less than 1 would tell you that it's inelastic, so probably consumers aren't really going to care about a change in price. Exactly equal to 1 is unit elasticity, basically just a step-for-step response to a change in price. So what are some examples of elastic and inelastic goods, and why are they that way? You can see there on the elastic side, you're looking more at luxury items, high-end items, and then you're on the other side with inelasticity, you're looking more at necessities, milk, gas, heat and power. And the reason that this is because with the inelastic goods, they're necessities. People need them. So like we saw, in 2007 and 2008 when gas was anywhere between $3 and $5, it didn't. Yeah, maybe it did change some consumer behavior, but people still need it. People are still going to buy it. And then on the other side of the spectrum with elastic, if there's an economic downturn or a significant or sharp rise in price, those luxury items are going to be the first thing that people will cut out of their spending. So how, I guess here's the grand question, how does elasticity relate to tax? That's kind of what we want to get at here. Basically, what happens is there's a tax incidence where the tax burden has to be shared between the supplier and the consumer. And the rule of thumb here is, as you can see there, if price elasticity of supply is greater than demand, then the buyers bear most of the tax burden. And then on the flip side, if price elasticity of demand is higher than supply, then sellers bear most of the tax burden. So it's kind of, I guess, just the opposite, and there's a trade-off there. So hopefully this was a good refresher for you. Probably wasn't teaching anything new, but just good to be reminded of, good to know for the upcoming exam, and I hope it can be of use. Thanks.
Today we're going to be talking about tax shifting and its purposes within the industry. So tax shifting is shifting or transferring of the tax burden from one entity to another. This can be seen in an example of a car industry with regards to the producer and the consumer. So if the government were to impose a certain tax, say a carbon emissions tax, upon the producer of the vehicles, the producer could decide whether or not to pass on that either a portion or all of the taxes onto the consumer. Now, this is only made possible through the elasticity of that specific industry. So, for instance, the automotive industry is relatively inelastic, and so that means that if a car is worth $40,000 and this tax burden that the producer is putting on this car is an additional $200, it's not going to sway you from deciding not to buy that vehicle anymore, because in your mind it's a necessity. It's what gets you to and from your job and gets your kids to school. So you're willing to take upon yourself that tax burden. Whereas in an elastic segment, the producer would have to take on that tax burden, the majority of it, because a certain price increase will steer them away. So that would be things such as food or clothing, certain technologies that would make that investor move away from, or not investor, make the consumer move away and not want to purchase that product anymore. Now, tax shifting is also in response to taxes in the progressive tax sense, where lower rate income is going to be paying a lower rate of income taxes than someone who is making a higher annual income. They'll be paying a higher income tax each year. Now this relates to vertical equity that says that as your annual income increases, so will your tax rates. And then horizontal equity can be seen within each tax bracket that's saying I'm making relatively same money as person B, and so we would be paying about the same amount of taxes each year. Now, in regards to taxes, when we receive these taxes, we can do what is called tax avoidance, which is changing our behaviors in order to reduce one's tax liability. So whether that's investing in certain bonds, such as a Series E bond, or certain government municipalities, it gives us the ability to reduce our taxes so that we can save some of that income and pay less taxes. As John Maynard Keynes once said, the only intellectual pursuit that carries any reward is changing your behavior so as to reduce your tax liability, which I think is pretty good. I think most people want to keep their income because they recognize that there's so much debt that they have to pay off, or expenses that they have to pay off, and the cost of living is increasing, that they want to be able to find more ways to save money for themselves and their families. It is not illegal. What is illegal is tax evasion, where one does avoid paying tax entirely, which is quite illegal. Fun fact I learned in my individual income tax class that the money you make from plasmas is technically income. Our professor said they classify it as a gift, but it's technically a service that you're giving, and so you're receiving payment for a service, so it is taxable. A lot of the students in our class did not know that, but it seems as the IRS isn't so concerned about college students making a little money off of their plasma. But the IRS can tell if you are avoiding tax payments depending on what your tax form is reporting. So this, isn't always the case. I believe it's lower than normal to have the IRS come find you. It would be the case if you were reporting, let's say $15,000 in taxes, but you're driving around in a Lamborghini or a Porsche or some kind of expensive vehicle, you're living in an expensive house. That's when the IRS would look into your taxes, into your 1040 tax form, and determine whether or not you are actually avoiding taxes that you need to pay. And at that point in time, they'll make that decision and go forward with any kind of proceedings so that they can get the taxes that you owe them.